Good afternoon, guys. So I just wanted to go over these articles in a kind of big picture. I'm only going to really focus on this value penguin article because the other article um, has one component that I'll hit on after we cover this value penguin. But this article is really good at giving you the broad overview of the different types of investment accounts, so you know which one to set up for yourself. Um, and you know the benefits and drawbacks of each one. You don't want to be like many young adults who open up one of these accounts and then they just let the money sit there. They don't know what it's for. They don't, and where they really get into trouble is if they put more money uh, in certain types of accounts than they should, uh, and then they need the money and they try to withdraw it and they're hit with a penalty. You don't want that. Okay, so we're going to go through that and kind of so that you know what the right decision or what the smart decision will be. All right. So these are the three main types of accounts that we're going to focus on. The first one is your individual retirement account. Um, these are accounts created by the government to encourage people to save for retirement. With that in mind, with that purpose in mind, there are some pitfalls and there are some rules and regulations with what you can do with the money in these accounts. Okay. The next set is the employer sponsored plans. These are also created by the government, and these really there are two main types of employer sponsored plans: your pensions and your 401ks. Or pensions are called defined benefit plans. And the reason that they're defined benefit is because with a pension, you know exactly what you're going to get every year when you retire. They do it all calculated out. They give you the paperwork and they say, look, we've contributed to this pension plan for you. You know when you retire, you're going to get this amount. Back in the 70s to 80s, a lot of companies had pensions, but they started moving away from pensions into and moving away from these defined benefit plans to something called the defined contribution plan, or as we mostly know it today, 401k. Okay, for private companies, it's the 401k. And it's called a defined contribution plan because you know upfront how much you can contribute, and you know upfront how much the employer is going to contribute if they're going to contribute. It really puts a lot more of the responsibility on the employee to save for their retirement than the pension did. The pension employees trusted the company to set aside that money. The company hired some people to manage the pension plans so that as their employees retired, they paid out. Um, then they moved to the 401k, partly because it cut costs. Defined contribution plans cost a lot less for companies than a defined benefit plan, right? But one of the potential negatives here is that it puts all of the responsibility to the employer, or sorry, to the employee. And the employee may not have the skills necessary to effectively manage or to save because they've been thrown into the situation without proper training. Well, that's one of the things that we're trying to do here, right? Because we know that the employers don't really spend time training employees about what to do with their retirement accounts. And so I want to prepare you all so that you do have an idea when you're put in this position. Um, you know how to navigate it. All right, so you're better off than everyone else. But this may be one of the reasons why baby boomers, the fact that the all the responsibility was put on employees rather than employers. One of the reasons why baby boomers, on average, are horribly prepared for retirement. Um, believe there was an article, I think that the article I read said that many baby boomers have less than $100,000 saved for retirement. It may have been 400,000 saved for retirement. Either number is not good. You're not gonna $400,000 is not something that someone can retire on. If they withdraw, $40,000 a year, that's 10%. That is more than uh, more than you want. More than any financial advisor says is a safe withdrawal rate. Safe withdrawal rates, the standard industry thinking has been a 4% withdrawal rate. If you withdraw 4% of the assets in your retirement account, that will be sustainable indefinitely for the rest of your life. And that's because the rest of your investments are invested in things that could earn 6 to 12 to 15%. So if you're only taking 4, those really good years of 12 and 15% will make up for the really bad years of like we have right now, right? Negative year to date, negative 7% or 10%. We're down 7 to 10% year to date in the market. So, right. But if you're withdrawing 10% and you continue to withdraw 10% when the market goes down, you're eating away into your principal, and there's no way that when the market turns around and goes back up, that you'll be able to ride that wave. So if you think at 4% and you only need $40,000 to live on, you need to have at least $1 million saved for retirement. Okay, you need to be a millionaire to retire with $40,000 coming out of your investments. Okay, we've already talked about, I know in class we've talked about Social Security, and I've had this conversation with Miss Hatfield too. She's a little bit more pessimistic. She's said that she doesn't think Social Security will be around when she and I retire, especially when y'all retire. Social Security will be around. My Social Security will be around as long as people are paying into the system. The big difference is you and I, we're not going to get 100% of our benefits. We may get 75% of our benefits because we don't have as many people paying in and other things as well. We're not funding it properly. Okay, but $40,000 a year plus Social Security, that may put you at around $60,000 to $70,000 a year in retirement, not accounting for inflation or anything. You need to have at least $1 million saved up for that. Most baby boomers don't, and it's going to be rough in the next couple of years. 10,000 baby boomers a day retire on average. Right. So we'll talk a little bit more about the employer-sponsored plans. And lastly, we'll talk about the taxable. These are your basic investment accounts. If government was not involved in creating different accounts, these taxable brokerage accounts would be the ones that are left. Your employer-sponsored plans and your individual retirement accounts were created by government. Okay, they were government programs to help encourage people to save for retirement, or to, in the case of 401ks, help businesses decrease their retirement costs. Okay, but taxable, that's the one that exists without any type of government interference. Okay, so individual retirement accounts, IRA. Okay, not the Irish Republic Army. That's a terrorist group in Ireland. They 70s, 80s, they were responsible for like blowing buses up and things like that. They're really bad people. Okay, they don't like that Ireland is split with the UK and Ireland. They want a united Ireland. But we're talking about the other IRA, individual retirement accounts. There are two types. There's the traditional, and then later on, we'll talk about the Roth. Okay. So traditional accounts first, it is pre-tax money that you're putting in. Pre-tax money, and then the money grows tax-free as well. Okay, so that's a big benefit. The fact that the money grows tax-free is huge, because if you had to pay taxes on the money every year, your growth is going to be diminished a little bit because you're having to take some out to pay those taxes. But the fact that it can grow tax-free, that's huge, 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 okay? And it's called tax deferred growth because you will pay taxes on this money that you put in a traditional IRA, but it's not until you retire and take money out. You are taxed when you take money out, and only on the amount that you take out. So you take $10,000 out, you're in retirement, you take $10,000 out of this account, you have to pay taxes on that $10,000. Okay, but you didn't have to pay taxes on it or you actually got a tax deduction for it when you put the money in, and then it grew tax-free. So you still come out ahead. Okay, it's still a benefit to you. But let's talk about when you should take it out and when you should not take it out. I'm going to jump down a little bit here, down to this last paragraph that we see. Individuals cannot withdraw money without penalties or fines from an IRA unless they are at least 59 and a half years old. I don't know why it's 59 and a half. That's just what the tax code says. When they created IRAs, they said 59 and a half. So if you are 59, not 59 and a half, okay? But you retired early and you're like, man, I really need this money that's coming out. I need to grab it out of here. And you're 6 months early, okay? You get hit with a 10% fee on the amount that you take out. So you take out $10,000. If you're 59 and a half or 60, take out $10,000, no fee, you just pay tax on that 10,000. If you are 59, 6 months early, and you take money out, you will pay a fee of 10%. Took out $10,000, you're gonna have to pay it $1,000 plus tax on the $10,000 you took out. So don't do it. That you're essentially volunteering to have your tax rate increased by 10% if you take the money out before you can, or before you're supposed to. Okay. So 10%, don't do it. Okay, so let's talk about limitations, because you have the tax-free benefit here, we want to put limitations on there. This is the government that created it. There are limitations. It's not free for all. So in 2016, a person can contribute up to $5,500 per year. In 2020, so for 2020, that amount is $6,000 per year. Okay. If you're over 50, right? So if a person, for 2016, if a person's over 50 years old, they can contribute $1,000 more. Same thing applies here. If over 50, you can contribute $7,000 a year. Now that we're in 2020, okay, and you don't want to over contribute. Okay, with a traditional IRA, you do not want to over contribute. You can, you don't want to. because any amount over that $6,000 a year, if you're under 50, will be count as after-tax money, and you don't want to mix after-tax money with pre-tax money. It's a bad idea. You'll have terrible accounting headaches trying to keep track of all that and getting it unwound, and really, it's so much of a headache. Okay, so why did it increase for people over 50? Because they're getting close to retirement, and so the government goes, hey, bud, you're about to retire. I know you didn't plan as much, or maybe maybe you didn't, but we're gonna give you an opportunity if you're over 50 to catch up, and so that $1,000 more to help you catch up for the lost years that you should have been contributing, but you failed to do so. Okay. Roth IRA is going to be very similar to a traditional IRA. In terms of limits, right? It's 6,000 in 2020, and for someone under 50, and 7,000 for someone over 50. The big difference here, though, is so you're able to invest money that you've already paid taxes on. So after tax money, and then withdraw that money later on tax-free. You never pay taxes on it ever again the rest of your life. It will grow tax-free, and then you never pay taxes on it. It's really nice. However, government created the Roth IRA to encourage lower and middle income people to save for retirement, and so there's an income limitation on here. You can only contribute if you're married and you're filing jointly, so 2 incomes. You can only contribute to a Roth IRA if you make less than $184,000. If you're single, make less than 117,000. This isn't perfectly doubled. Not sure why that's not perfectly doubled, but that's the situation that we're in. Okay. They have these things. This area right here is called phase out, because by the time you make over 194,000, if you're married filing jointly, you're not eligible. So the period between these is called the phase out. We're not going to worry about that. Okay, we're just going to look at these income limitations. Okay, the main ones. So that's the case. You make over, let's say you're single and you made $140,000. Sorry, you suffer from making too much money to contribute to this account that the government created. I think it's reasonable. Government created this account. They get to set the rules for it. Okay. But the same rule applies here. If you're under 59 and a half and you take money out of your Roth IRA, you're going to get a penalty for it. So don't do it. Okay. Now we get to employer-sponsored plans. Okay. The main type is the 401k. This is for private for-profit companies. Okay, another one, and the 401k refers to the section in the tax code where the rules for these plans are set up. So 403b, that's the section in the tax code where the rules for this plan is set up. 403b, just like a 401k, but it's for private, non-profit organizations. So Boy Scouts of America is a private non-profit organization. They have a 403b. Westbury Christian School, we are a private non-profit organization. We have a 403b. Okay. And then the last main one that we're going to focus on is the 457. tax code, section 457, and this is for government. If you work for the government, typically you would have a 457 defined contribution plan. Okay. The rules, just like before, there's a traditional and a Roth. General rules still apply. There is one caveat with the Roth. Okay. Roth 401k. There's some lag on my pen. No income limit. Which is really insane if you think about it. Okay. So real quick, and I'll talk about why that's kind of insane that there's no income limit on a Roth 401k, but there is an income limit on a Roth IRA in just a minute. But one of the big differences here between a 401k, 403b, 457, and an IRA is the amount that you can contribute. Okay, for for an IRA, you're limited to $6,000 per year, and we're just going to assume that you're under 50 here. Okay, for a 401k in 2020, the limit was $19,000. Okay, in 2016 it was 18,000. As years go on, it increases. So this is why it's really insane that there's no income limit on a 401k Roth, but there is an income limit on a Roth IRA. No income limit. It's one of those things. The Roth was created to encourage lower and middle income people to save for retirement. Okay, well, the people that are most likely able to maximize put $19,000 away in addition to their $6,000, right? So that's $25,000 away to retirement every year. Someone who is not in the lower or middle income, right? They will most likely be upper income people. Okay, so Roth IRA goes, hey, you make too much money. We can't have you contributing to $6,000 to your Roth IRA. But then those same people just go around to their 401k and say, hey, you make a lot of money, but that's fine. You can contribute $19,000 to a Roth 401k. It makes absolutely no sense. Why have the income limitation on a $6,000 contribution, but not on the $19,000? In my opinion, they should be treated the same. Yeah, if there's an income limitation for a Roth IRA, they should have that income limitation for a Roth 401k. Treated the same. But Congress wrote the tax law, so yay, Congress. Okay. Another big difference between the 401ks and the IRAs is that a 401k or any of these, 401k, 403b, or 457, typically you can have a matching contribution from the employer. So for example, let's kind of read through this. If the employer may, or for example, an employer may offer to contribute 3% of an employee's salary if they contribute at least 6% of their salary to their 401k each year. So the question is, should this individual contribute 6% of their salary? Yes, because they're getting an extra 3% to their 401k. And if Netflix specials have taught us anything, an extra 3% is a good thing. But really, that's kind of like a 3% boost in your salary. And by choosing not to contribute, you're saying to your employer, hey, don't worry, I don't need that 3% extra money, right? You need to contribute. Don't leave money on the table. Okay, so 401k offers employer matching. Okay. Another big thing with the 401k is when you leave the job, so IRAs stay with you no matter what. They're yours. Employers have no say with an IRA, but your 401k, it's tied to your employer. So if you leave a job and you move up to another job, make sure to go ahead and move your 401k over to your IRA, assuming that your 401k is pre-tax. Again, keep pre-tax with pre-tax. If you have a Roth 401k, take that 401k and move it. You change jobs, take that 401k and move it to your Roth IRA. Okay, pre-tax, the pre-tax, after-tax to after-tax. Keep it with that. Okay, simple and SEP. Really not going to focus too much. Simple IRA, SEP IRA, they're smaller businesses, retirement accounts. SEP is mostly used by self-employed individuals. I know it stands for Simplified Employee Pension, although it's really not a pension in the traditional sense of the word. Another acronym you can use to help remind you which one is which: self-employed persons. SEP, self-employed persons. Okay. Let's see. Okay, and then our taxable accounts. These are the accounts that, as they would exist without government rules. Okay. You pay taxes on the gain in these accounts every year that is realized. Okay. So pay tax only on realized gain. Okay, so what does that mean? What does realized mean? It means that you have actually sold a stock position or a bond position and you have made money. Okay, let's say I own Apple stock, and Apple, I have 100 shares of Apple stock. I don't know what Apple stock price is right now. Let me do AT&T because I know what their price is. They're around $30. Okay, so I own 10 shares of Apple, of AT&T at $30 a share. So that's $300 that I have in AT&T. Okay, and let's say it increased. The AT&T reported great numbers, and it increased from $30 increased to $50 per share. Okay, but I still I still have the 10 shares. But now those 10 shares, they were worth 300. Now total, they're worth 500. Do I have realized gain yet? Answer is no, because I have not sold anything. Okay. When I choose to sell AT&T, if I choose to sell it at $50 a share, okay, I bought it at 300, sold at 500. Okay, 500. So realized gain is 200. So I would pay tax on that $200. Okay. Now, let's say I own other things too. And let's say some of my other investments really didn't turn out that well. In fact, I had one that I bought at 500. Okay. So I bought at 500, sold it at 400. That gives me a loss. What type of, it's a realized loss of $100. Okay. But if these are both in the same account, or if they're both in taxable accounts, I'm not going to pay tax. Like, I have a $100 realized loss and I have a $200 realized gain. I'm not going to pay tax on this all 200. I'm going to take the realized gain and subtract from it the realized loss. So my loss was 100. Okay, so I pay tax. I end up paying tax on $100. Okay, that's subject to tax. Okay, and so if that happened in a single year in my taxable account, I would pay tax on the $100 because it was the total realized gain when you offset the losses. Okay, um, and depending on how long I've held it, hopefully it's capital gains instead of just ordinary gain, or long-term capital gains instead of short-term capital gains, because long-term capital gains are taxed at a lower rate than short-term. And for something to be long-term, I must own it for more than 1 year. Okay, so as long as I own it for a year and a day, it's considered long-term. If I bought it and then I sold it 364 days later, I bought it and sold it under a year, it's short-term. Long-term capital gains get a lower tax rate. And short-term capital gains taxed as regular income. So if any of y'all are playing around with day trading, buying and selling, the same asset within the same week, you're going to have to worry about the short-term, long-term capital gains. I know that that's been one of my concerns, and hopefully they are doing it right. But I think we've all heard of people dabbling in the foreign exchange market using forex and buying and selling currencies. I hope that they're paying tax on that and they're keeping track of their records, because if they did that for 2019, they have to pay taxes on it this year, and hopefully they're not getting them. They're not digging themselves a hole by not keeping records here. Okay. Oops. Okay. Anything else I want to talk about? No, y'all can read through that. Okay. The one item over here on the Just Start Investing. We've talked about individual brokerage. We talked about the IRAs. We talked about the 401ks. This 529 account. This is a college savings account. You're really not going to focus on it because for you, college is next year, or it's under a year away. And so you really can't you can't do an investment in under a year. There's too much risk to doing that. Investing should be for the long term, over a year, maybe even over 5 years. If you're planning on buying something, if you're saving up to buy it within the year or within 2 years, you don't need to be investing it. You need to be saving it in a savings account where there's no risk. Okay, because if it's going to come up in a year, you don't want to put that money in and then have the market tank and you lose money on it, right? You want to manage your risk. So 529 college savings accounts, your parents may have set one up for you. The benefit here is you put pre-tax money in, just like an IRA. It will grow tax-free, just like an IRA. And then when you get ready to take it out, if you use it for education-related expenses, tuition, books, room and board, okay, college room and board, if you use it for those related expenses, you don't pay any tax on it at all, right? It's tax-free. If you use it for reasons that aren't education-related, you pay tax on it, and it'll be like you taking money out of an IRA before you're 59 and a half. You get hit with a penalty and to do it too. So don't do that. All right, guys, that pretty much sums it up. I'll be posting the quiz later. I just wanted to give y'all a chance to view this video before taking the quiz because some of the questions from the quiz will come from this video. All right, see y'all later.